One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of investment banking. My name is Alex Mason, and I am your host. Thank you so much for joining me today. I'm grateful that you're here to learn and grow with me as we break down these concepts one by one. That's how we're doing it every single day, 7 days a week. You know what's up. Thanks for joining me. And today we're wrapping up this section on advanced accounting concepts. And we'll definitely talk about accounting later on in the show. But as far as really the basic concepts, as well as some core advanced ones, this is it, ladies and gentlemen. This is it. We have gone through them all. And so let's go ahead and quickly talk about today's question. Why would depreciation and amortization be different on the income statement versus the cash flow statement? Why would it be different on the income statement versus the cash flow statement? So thinking about the three financial statements, you look at the income statement, it has expenses, it has revenue, it has net income. You look at the balance sheet, it has assets, liabilities, and equity. And you look at the cash flow statement, it's got cash flow from operations, cash flow from investing, and cash flow from financing. These are the three main statements. Now, where does depreciation fit into all of these? Well, first of all, let's go ahead and think about our income statement and see what it tells us. The expenses on an income statement will fall into one of two broad categories. You either have your COGS, that is your cost of goods sold, the expenses that it took to actually make the product. And then you have operating expenses, which, that could be so many different things. It could be research and development, could be paying payroll, it could be a lot of things. And depreciation and amortization, it's usually hidden within the operating expenses of the income statement. That's usually where it's hiding. Now, some companies will spell this out as a specific line item on the income statement, but many do not. And I would even go so far as to say most do not. It's actually embedded within your costs. So that's where it's hiding in the income statement. Now, on the cash flow statement, let's think about this for a second. The cash flow statement will help you find what depreciation and amortization is more quickly because it's added back as a non-cash expense. Remember working your way from net income at the top of the cash flow statement down to cash flow from operating activities. In between net income and cash from operating activities, you add back depreciation and amortization. So that's where you can find it really fast. You can then use your depreciation and amortization number to help you do calculations like help calculate EBITDA, for example. So that's the difference really between the cash flow statement and the income statement when it comes to depreciation and amortization. On the cash flow statement, it's a little more clean, it's a little more clear, whereas on the income statement, it's more hidden and it's hard to kind of make a direct comparison, but the expense is there. So that's what I would say in response to this question, with depreciation and amortization being different on the income statement versus the cash flow statement. Okay, so that's what I got for you today here on Investment Banking Insights. Short episode for you today. Thank you for grinding out these accounting questions with me. I hope you've learned as much as I've learned going through this. And yeah, it's just been a great ride to learn all these accounting concepts. And yeah, I'm going to be reviewing them myself to make sure I really understand. So remember, if you don't understand a concept, just go back and listen to the episode again. I've designed this show very intentionally with bite-sized pieces of information for that specific purpose, because I know that everyone is at a different place in their preparation and understands different things. So you can cherry pick the bits of information that you want to review more of or less of. So that's my intention. So that's what I got for you today here on Investment Banking Insights. My name is Alex Mason, and I am your host. And join me next time as we go into another topic and get into some more advanced other concepts outside of accounting. So I'm looking forward to that. I'll see you next time. Take care.